Live from New York City this morning. Good morning, good morning. 8-day winning streak on the S&P 500. Futures positive. Can we make it day 9? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Ken Griffin says high inflation is here for decades. As Fed Chair Jay Powell takes the stage once again, Yellen is kicking off 2 days of talks with China. We begin with the big issue, an 8-day winning streak.
This rip-roaring equity market rally in the S&P
has been a well-deserved sigh of relief.
Relief rally after such a dismal couple months.
The stock market rallied because the bond market rallied.
There's a bit more reason for investors to be a bit more optimistic.
Now we know that major central banks are on hold.
Fed is done hiking.
We expect the market to continue to rally
Into the end of the year.
Move higher to your end.
Historically, when you have a weak or a negative August, September, October, you have an up end of the year, November, December.
It looks to us like it's a bear market rally and not something that's sustainable.
There is space for negative surprises in the earnings picture for next year.
We should still be prepared for a larger pullback or mild recession coming.
It's not going to be a straight line for the stock market.
We haven't really written the entire story just yet, so we'll see how it unfolds from here.
Let's have that conversation right now with Mohammed El-Erin of Queen's College, Cambridge. Mohammed, what a rally in the equity market inspired by a major bond market move. Your piece this morning, let's get straight to it. This line right here, for all of us who hope for greater certainty and less yield volatility. Mohammed, how disappointed are we going to be?
Thanks for having me, John. First, the rally has been driven not just by lower yields and a ton of refinancing that has allowed the capital structure to be strengthened for companies, but also by lower oil prices. Don't underestimate the impact of oil prices, both on the supply side and on the demand side, when it comes to the typical company. Now, we all want more stability in the Treasury market. The Treasury market is central to so many other markets, and having 8 to 15 basis points moves every day as something regular is not good for the functioning of that market. It's not good for other markets. It's not good for the economy. It's not good for the standing of the U.S. in the financial system. So we all want greater stability. The Fed is moving off center stage. The Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away, because you have a tug of war that we're going to see playing out between issuance and between a softer economy. And that tug of war means that we're going to continue to see this volatility. But I don't think to the extent we've seen it before, because the Fed is not going to be confusing things anymore.
So do you think we are confusing a rally in the bond market with stability?
Well, it hasn't even been stable, John. Yesterday, we moved 8 basis points, and the stock market did nothing at all. But the bond market is still moving. There's still a lot of underlying tensions in that bond market. Issuance, John, I'll give an example that comes from a colleague at Gramercy. For the whole of October, there was 14 billion of issuance in emerging markets. This week alone, there's been 14.5 billion. So this week alone, everybody has rushed, understandably so, to issue because the volatility had kept them on the sideline. So the issuance element is contributing to what we see volatility, even though I agree with what most people will think, which is the Fed is done. It certainly should be done, and I suspect it is done.
Let's build on that, Mohammed. We've had a lot of EM issuance, a ton of credit supply, corporate issuance in America, Treasury too. Can you speak to whether that's been received well, how well that's been received, and whether we can take comfort from that this week at least?
So far it has been received, but I don't think we can take comfort from it. It has been received because away from treasuries, issuance has been quite low in the last few months because of the volatility in the market. Going forward, there's a lot of issuance that has to be done. There's a lot of issuance by the government that needs to be done. And John, there are question marks about the buyers. The Fed is not a reliable buyer anymore. In fact, the Fed is reducing its balance sheet. Japan and China have internal issues going on that makes them fewer buyers. And some institutional investors and banks are still sitting on quite huge losses from treasuries. So I think we are going to be learning a lot about auctions. We're going to be learning a lot about refunding announcements. This issuance dynamic is going to be with us for the next, at least, I suspect, at least, John, 15 months.
So 2 questions I have for you, if that is the case. One, is the Fed done? You think either it is or ultimately it should be. So let's leave that there. Let's get to this piece of the question, Mohammed. Have we seen the high for yields for this cycle? The move that we've had over the last couple of weeks is about 50 basis points, a break of 450 yesterday on the 10-year, down from 5%. Have we seen the high for the cycle?
So we've seen the high, okay, for the Fed. And I want to say that's important because Ken Griffin is right. We're living in a more inflationary global economy. You've heard me say it's no longer about insufficient demand, it's about insufficient supply. Now, why is the Fed done? Because they're going to get the air cover from headline inflation coming down very rapidly. So even though core inflation is going to be sluggish, they're going to get air cover from headline inflation. As to the rest of the curve, this is going to be about the further out you go in the curve, the greater volatility you're going to see as you get this tug of war playing out. And it's too early to tell how that's going to play out, John.
Well, you said Ken Griffin's right. So by extension, I wonder if you think Goldman Sachs is wrong. The team over at Goldman, led by Yen Hatzius. Let me share some bullet points with you, Mohammed. I'll go through them right now. Their outlook for 2024. They say the hard part is over. More disinflation is in store over the next year. The full disinflationary effect is still playing out. Core inflation should fall back to 2 to 2.5% by the end of 2024. They continue to see only limited recession risk going into next year and increased willingness of central banks to deliver insurance cuts if growth slows. Mohammed, what would you say back to that?
So I do think we're going to get more disinflation at the headline level, and it's going to be quite sharp disinflation. I would disagree with them on the notion that core is heading to 2%. I suspect core over the next couple of years is going to be more around 3%. John, we have some real things happening on the supply side that are going to play out over a number of years. You've heard me talk about it. You have the fragmentation of the global economy. You have non-commercial consideration driving supply chains. You have companies building more robustness in their supply chain. You have the energy transition. All that is inflationary. That's not going to go away anytime soon. So I would push back against their 3%, their 2% core, and say core will probably get stuck more around 3%. As to what central banks will do, deep inside, I think at the end of the day, and you and I have discussed this, they will keep on promising us 2% down the road, and we will run with slightly higher core inflation, and we're going to find out that it's stable.
We'll hear from Chairman Powell a little bit later. For those of you just joining us going into the opening bell, equities positive again this morning by 0.2% on the S&P 500. This is an 8-day winning streak on the S&P. We make it day 9. It's the longest winning streak going back to 2004. Mike McKee, plenty of Fed speak still to come a little bit later.
Yeah, Chairman Powell at 2 o'clock this afternoon, so we'll see if we make that 9th day or not. The problem for Jay Powell is that Wall Street hasn't been listening to what he had to say. This is what he said in his news conference following last week's Fed meeting. The fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. What happened? Well, the day after he said that, the market priced in more rate cuts and sooner. So the Fed and the markets are somewhat at odds right now going forward. The Fed doesn't have to make a decision right away. The markets reprice every few minutes. So then does the Fed chair need to push back, or does he stay away from the current economy at all? Because this is a panel on international problems, monetary policy challenges in a global economy with Israel's Amir Yaron, Ken Rogoff, and Guido Gopinath from the IMF. It's not necessarily going to be a situation where he wants to talk about the U.S. economy, but we shall see. And if he does, or if all of these people want to talk about, in general, the problems they face, you can see here what they are. Manufacturing starting to slow, the white line. Inflation, the blue line, is still high, even though it has been coming down. And the economic surprise index for the world has been up and down, but trending lower. So they all have kind of the same problem. Does Powell stick to that, or does he want to send a message to his markets that they're going the wrong direction too quickly?
The title of that, is that Global Meh? Is that what that says, Mike?
Global Meh.
Global Meh.
That's kind of
like
the way you could describe it now. Yeah.
Nice, nice. Mike McKee, thank you, sir. Mohammed, some final thoughts, please. Let's not go to Global Meh. Let's talk about something a little bit more important than that. How quickly this narrative has shifted. And you identified 2 points, not just the bond market, but also in the commodity market. I think it's really key that yesterday we had a break of 450 on a 10-year at the same time that Brent crude broke below 80 and into the 70s. Mohammed, are we getting to a point where we start to think more about maybe a growth slowdown that is less friendly to risk assets, equities, credit, etc.?
Yeah, that's the big fear, that interest rate risk goes away and then credit risk comes center stage. John, you know, I do worry about 2024. I worry more about 2024 than I worried about 2023. I remember when Bloomberg Economics came up with recession is 100% likely, you know, probability, and I said no, it's not at all. In fact, we can avoid a recession. I'm not so sure about 2024. Savings have been run down. There's a cumulative impact of higher interest rates. The global economy is more sluggish. 2024 is going to be a tougher year than 2023 was for the global economy.
For the global economy and for markets too?
It's an interesting one, John. I suspect that we will see an enormous amount of dispersion, an enormous amount. And so I hesitate in answering your question because it depends which market. If you're in private credit, you're going to have a lot of opportunities as good borrowers find themselves rationed in certain markets and look to the private markets. If you're in public markets, it's going to be pretty volatile.
Hey, Mohammed, we've got to leave it there. It's always great to catch up, buddy. As always, Mohammed Al-Arian on the latest for the global economy, for markets, for central banks as well. 20 minutes away from the opening bell, equities look like this on the S&P 500, pushing higher by 0.2% with some movers going into the open. Here's Abby.
Well, certainly helping out the gain, at least right now, John. We do have the shares of Disney popping higher. This after a very strong quarter that they reported. They beat earnings by 19%. There was a slight sales miss, but that profit comes amid the cost-cutting plan. And Bob Iger, CEO over there, is signaling another $2 billion could be cut soon. And this, of course, ahead of Nelson Peltz's cost-cutting push on the board. Theme parks and streaming, a smaller loss for streaming, helping out that profitability. NVIDIA higher amid some of the FOMO that you're talking about, this 8th up day for the S&P 500. Plus, there's a report that they may be releasing 3 new AI chips to China, but not joining the party. Tesla, it's down, and HSBC has launched with a reduced rating, saying that overall they believe in CEO Elon Musk and that they do what they say, but they're a little bit nervous right now about the timing of deliveries of those EVs.
Stock down 1%. Abby, thanks for that. More from Abby around the opening bell. Coming up, investors bracing for day 2 of Chair Powell after a quiet day 1.
Even with state-of-the-art models and even in relatively calm times, the economy frequently surprises us. But our economy is flexible and dynamic and is subject at times to unpredictable shocks.
Looking ahead to Chairman Powell with All Springs, George Bory, Matt Miskin of John Hancock Investment Management. All of that still to come.
Economic models do a reasonably good job of capturing the working of the economy over past decades. Of course, even with state-of-the-art models and even in relatively calm times, the economy frequently surprises us. But our economy is flexible and dynamic and is subject at times to unpredictable shocks, like a global financial crisis or a pandemic.
That was yesterday. Fed Chair Jay Powell giving markets very little to chew on. Potentially a different story today, with investors bracing for fresh remarks at 2 p.m. Eastern Time. Speaking at an IMF panel in Washington, D.C., here's why Mohammed Al-Arian thinks the Fed might be done.
Why is the Fed done? Because they're going to get the air cover from headline inflation coming down very rapidly. So even though core inflation is going to be sluggish, they're going to get air cover from headline inflation.
Let's continue that conversation. John Hancock's Matt Miskin, Allspring's George Bory. Matt, do you agree? Is the Fed done? Is it all over?
We do. And, I think what's interesting is the core conversation there, because what we're seeing in core is that 70% of core inflation has been driven from shelter. And housing is going to be really a big part of that. And right now, the Bureau of Labor Statistics is still calling housing prices up 7% year over year. Data we're seeing from like Zillow or other resources are looking more like at flat year over year. So we actually think core is going to be coming down. Headlines still going to be whipped around with gas prices, but there's a lot of disinflationary developments as of late. We think that is going to help inflation get lower into 2024. And we think as a result, the Fed doesn't need to raise further from here.
What's the price we've got to pay to get inflation lower from here? George Bory, is it too early to get comfortable with this somewhat painless retreat in inflation?
It is a bit too early. I mean, as we just heard, there's good indicators to suggest inflation continues to creep lower. So directionally, inflation is pointing in the right direction, which does give the Fed air cover. But as we know, what the Fed does is important, but what we think the Fed will do is really what's most important. And so where the Fed has air cover right now is that the market believes that they want to ultimately get to their target. And so while they don't need to raise rates any further, at least not at this juncture, and they've been in this holding pattern now for almost half a year. And then the need to do so, to move, is really non-existent right now. But what Powell and the team are doing is they're playing a sort of a mind game, if you will, with the market. They need the market to believe that they will move if they need to. But in reality, the data is telling us that they can sit pat for the foreseeable future.
And when we talk about the data, we're also talking about the labour market data. I've seen this line from Citi's Andrew Holdenhorst, from Neil Dutta of Renaissance Macro, that ultimately the labour market is not a reason to be hawkish anymore. Matt, let me frame it a different way. At what point does the labour market become a reason to be bearish?
Yeah, so bad news is going to be bad news at some point. It's been amazing, this good news, bad news, and then now bad news, good news development. I mean, last week, it was just such a reversal. Like you said earlier on the show, I mean, it's just such a narrative merry-go-round here. But so now we're in bad news is good news. But the thing is initial jobless claims, if they actually start rising, high yield spreads, if you overlay initial jobless claims with high yield spreads, it's the same thing. It's the last thing to go. And the best coincident indicator you can use for the economy. And for now, it's low. We just got it this morning, 217,000. But look at the continuing claims. When we look at the labor picture right now, what we're seeing is there's hiring, but the hiring is really concentrated in government jobs and healthcare. You take that out, there's not a lot of hiring right now. And we actually think the labor market's really deteriorating underneath us. And we think it's not showing up yet in initial jobless claims. But as we get into 2024, we think unemployment rate rises and we think high yield spreads widen. And that's when stocks are not going to be happy about it.
Matt, you think we're late cycle. Goldman thinks this cycle can continue through 2024. I'm just reading through the note from Jan Hatzius again. I suggest if you can get hold of a piece, everyone should have a read of it. It's incredibly constructive. They're talking about tailwinds to global growth in 2024, only limited risk of recession. Matt, I'm sure you're taking the other side of this, but what do you think they're getting wrong?
So we haven't had a recession in 12 years. It's almost like we have to go back and think about traditional monetary policy cycles. After the Federal Reserve raised rates significantly, and we just went from one of the easiest monetary policies and fiscal policies in this country's history to now a whipsawing to the most tightening we're seeing in other than 1980. So we have gone from easing to tightening really fast, 3 years. And I think what's often misunderstood or misplaced is just saying, hey, Fed can raise rates a lot and the economy's just going to be fine. There's no lagged impact of monetary policy. We'll take the other side of that. You look over the long term, after the Fed raises rates a lot, eventually the economy slows down. We still think that's in the pipeline into 2024.
The labour market call here is key for next year, for 2024. George Bory, Torsten Slock of Apollo wrote this morning. He said everyone who is bullish on equities and lower rated credit should ask themselves where they think the labour market will be in 3 months, with the Fed on hold and not showing any signs of cutting anytime soon. George, as you start to add a little bit more duration, go out further along the curve on treasuries, George, how are you thinking about developments in the labour market as you do that?
Well, as we know, labor obviously is the main driver of the economy. And as we just heard again, it's not as binary, we think, as many are kind of making it out to be. Monetary policy works, and it will be a persistent headwind. And it is a bit surprising that the economy is holding up as well as it is. But there are two big factors. One is just the starting position of consumers. Defaults are ultimately driven by inability to pay. So there's a combination of earnings plus whatever you're needing to refi into. That pressure mounts as we move through time. But starting from a good spot for both many individuals as well as corporations, having a lot of low-cost debt on their balance sheets, it's a big help. And so when we think about next year, labor matters. Absolutely, labor matters. But we think growth continues, slows, but it doesn't necessarily result in a recession or a hard recession. We could have just slow, sluggish, kind of zero type growth for quite a while as the heavy cost of borrowing, the heavy real cost of borrowing kind of weighs on individuals, weighs on corporations, and kind of slowly gnaws its way through the balance sheets. One thing about inflation is it's not a universal bad. Many companies, some individuals actually benefit from a higher inflationary environment. And so it's this big rotation, both from an operating standpoint, financing standpoint, and ultimately the economy, which is what we're working through. So we're not convinced that it has to be this binary, really hard, really soft landing. It could really just be a sluggish, ungratifying landing, which a little bit of duration and a little bit of credit can do very well, especially given where yields are. If investment grade yields are up around 6% and high yield is up around 9.5%, there's a lot of income there to cushion you against that rate ball and still absorb some of the credit risk.
George, we've got to leave it there. George Bory, Matt Miskin, reminds me of that line from Kit Dukes of SocGen this morning. Yields and the dollar might have peaked. Frustration levels haven't. Coming up, the morning calls, and later, stocks looking to match their longest winning streak in nearly 2 decades. Equity slightly positive. Let's get you some morning calls. First up, HSBC initiating coverage on Tesla with a bearish reduced rating, pointing to challenging delivery targets and overly optimistic investors. Next up, Evercore adding 5 below to its analyst outperform list, expecting shares to rally heading into the holiday season. And finally, Wells Fargo raising its Disney price target to $115, expecting shares to benefit from further cost cuts and improving free cash flow. That stock is up 4%. Coming up, fundamentals, fear, and the Fed. Why Joanne Feeney is calling them the 3 keys to the markets. That conversation is just around the corner. Your opening bell up next. What a rally, what a rally. Let's set the stage for you. 20 seconds out from the opening bell this morning. Good morning to you. 8 days of gains on the S&P 500. You know the numbers by now. Longest winning streak going back to November 2021, 2 years. You make it day 9, it's the longest winning streak going back to 2004. Equity so far a little bit higher. There's the opening bell. Switch on the board and get to the bond market. Yields look like this morning, higher by 4 basis points. Your 10-year 452.94. Yesterday a break of 450 in the other direction. From 450 to 452. Think about where we were before, 5%, north of 5%, and then a break of 450 in just the last couple of days. Only a few weeks ago, we had a 5 handle on that 10-year yield. In the FX market, the euro not really doing much at all, 107. Yesterday, when I was looking at that move, breaking 450 on a 10-year, I was looking at Brent crude breaking 80. WTI is still in the 70s, 76.15. We're positive there by 1.1%. About 30 seconds into the session, here's day 9 on the S&P 500, another day of gains. The S&P advancing by 0.2%, the Nasdaq up by 0.25%. One stock to watch at the open is Disney. Shares moving higher after topping Q4 profit estimates. Bob Iger looking for sustainable profitability in our streaming business, building ESPN into the preeminent digital sports platform, improving the output and economics of our studios, and turbocharging growth in our parks. With more, here's Abby.
Well, investors liking this quarter quite a bit, John. We have the stock on pace for its best day since August 10th, and now higher slightly on the year as well. Going into this print, the stock had been down a little bit on the year, and it has everything to do with that profitability. They did post an adjusted earnings of 82 cents. That's 19 cents better than the street. Slight sales miss, but profitability is really important because it signals the cost cutting that they've put into place, that it is working. And in fact, CEO Bob Iger signaling that they will cut another $2 billion, and a piece of it, the parks that you were talking about, and also streaming a loss that was smaller than had been expected. In fact, the flagship theme parks, going back to parks, delivered the biggest profit boost, earnings rising by about 31% for the period ended in September. But it's not all unicorns and rainbows, or whatever the saying is, because there is, of course, a battle to some degree looming with activist investor Nelson Peltz. He is seeking several board seats. But I think that in terms of the profit that was delivered and the cost cutting that is perhaps to be put in place still, that $2 billion, well, maybe there's something that Bob Iger and Nelson Peltz can agree over, John.
The stock is up by something like 5% this morning. Abby, thanks for that. Let's stick with earnings and check out Lyft. Delivering a lackluster forecast. The CFO saying this: our Q4 outlook calls for continued progress, and the updates we're making better align our reporting with our strategic priorities. Ed Ludlow joins us for more. Morning, Ed.
Yeah, morning, John. Lyft dropping hard out of the open, down more than 6%. The story is a beat in the quarter gone, but the guidance into that December quarter is really worrying the street about how Lyft catches up with Uber. Sales rose 10% in the September quarter to 1.16 billion, and the guide is a mid-single digits quarter-over-quarter gain into the December quarter. The average analyst projection into the end of the year is 1.19 billion, so that's now a big question mark of whether they'll meet that. We learned quite a lot about Lyft's business because of the new metrics that they are now sharing, including gross bookings. Those grew 15% year on year to 3.55 billion. But they're also telling us about their ridership. It isn't just ride share, but also scooters and bikes on the platform. Rides overall up 20% to 187 million, and then ride share distinctly up 22% year on year. There's a real concern about the take rate because of how heavily Lyft is discounting in order to catch up with Uber. In other words, they're not really booking the revenue per gross booking that Uber's able to get to. And also their cost base is just much higher than Uber. So it is a concern, and I'll ask the CEO about that later on my show, John.
Well, Ed, you also spoke to Uber earlier on this week, so let's build on that. What is Uber getting right that Lyft's getting wrong?
Big difference is supply. They're able to bring in the drivers, partly because of their diversified business, right? Supply was boosted for Uber 32%, because if you're a driver, you have the incentive of, when you're not doing rides, to do food delivery. Lyft has really struggled with supply, so it's discounting heavily, but it also can't grow its volumes in a meaningful way, and that means, and it's reflected, right, in the revenue forecast going into the end of the year. They're going to have to do a lot of belt tightening, but also think smartly about how they grow their business too.
Ed, thank you. Stock is down about 6% this morning, about 4 minutes into the session, just about holding on to day 9. Day 9 of gains on the S&P 500, up by 0.1%. Let's turn to the pharma space. Eli Lilly gaining US approval for its diabetes drug to treat obesity. The FDA writing this: in light of the increasing rates of obesity in the United States, today's approval addresses an unmet medical need. Katie has more. Hey, Katie.
Well, you look at shares this morning, they're down slightly, but that's after they closed at the highest level since Eli Lilly went public in 1980 after getting that nod from the FDA yesterday. The regulator said that in trials, patients who received the highest dose of Eli Lilly's Zepbound, that's what it's called, lost an average 18% of their body weight, which is quite a lot. Now, Zepbound, it'll cost $1,060 for a 1-month supply. That is cheaper than Novo Nordisk's Wegovy, and Eli Lilly says that this will be available soon after Thanksgiving. And John, to call the hype around these weight loss drugs a frenzy would be an understatement. Both Eli Lilly and Novo Nordisk are trading near their all-time highs right now. This market overall is expected to be about $100 billion by 2030. And Eli Lilly right now, you can see, down almost 3%, but this stock is nearly 67% higher year to date.
What a move. Katie, thank you. I find this story absolutely fascinating. What these drugs are going to do to this country and what it's ultimately going to change about our eating habits, and how that's going to change some of the stories out there in food packaging companies, food companies in America. That's one to watch through 2024 for sure. Let's turn back to earnings. MGM Resorts topping estimates despite a cyber attack in September. The CEO with this to say: while we were faced with a difficult cybersecurity issue, we are a stronger company having been through the challenge. Simone Foxman has the story. Hey, Simone.
Yeah, hey, John. MGM Resorts really hitting some winners here in the third quarter. Not only seemingly able to overcome that cyber attack with bookings returning to normal in Las Vegas in October, but also topping numbers in third quarter. Earnings per share coming in at 65 cents versus the expected 45 cents. Revenue $3.97 billion. That's about $100 million more than the street was anticipated. Seeing better than expected performance out of China, but also above expectations in the Las Vegas Strip, which, although it's down about 8.5% year on year on a revenue basis, is the company's largest geographic segment. Also, shouldn't note that the company announced a new $2 billion buyback program. So that could be some of what we're seeing, giving the stock a lift today. Macro-wise, the company's seeing some softness in China, but not really super concerned about macroeconomic headwinds elsewhere. And on top of this, we got some decent news on the labor front. So there's a union of Las Vegas hospitality workers that's been really about to strike, but they seem to have struck a tentative deal with Caesars. MGM executives on the call also signaling that they're close to a deal. So despite the fact that shares are down about 20% since hitting a high in late July, we're seeing some enthusiasm this morning. Shares up about 2.4% on a little bit better outlook for its hospitality business than I think everyone was fearing.
Simone, thank you. About 7 minutes into this session, these are the scores right now. We are positive by just 0.01%. You hold on to those gains. It's the longest winning streak since 2004 on a daily basis. Here's Evercore's Julian Emanuel on what's been driving this latest rally.
In this world now for the last year and a half, where stocks and bonds have been positive correlated, if bond yields go down, stocks go up, and backing off of 5% was huge for the psychology.
Joanne Feeney of Advisors Capital joins us right now. Joanne, let's get straight into it. Massive move in the equity market, inspired, supported by developments in fixed income. Was it just about fixed income? Is it something more? And how sustainable do you think it might be?
Well, John, I certainly think that the drop-off in interest rates was coordinated with the investor renewed enthusiasm for risk on assets. We saw a big drop-off over the course of the summer, in enthusiasm for company stocks because of the earnings reports that they feared were going to come out weaker than expected. And it turns out we got better than expected earnings. But as we'd like to say in some areas of life, what have you done for me lately? In stocks, it's what are you going to do for me in the future? And so it turns out it's all about guidance. And we're seeing investors now look forward to 2024. And with the economic data coming in a little bit better than expected, maybe we're not going to see interest rates stay as high for as long. I think that's a little bit of a misread of what the Fed is up to, but I think that's where investors are in the market.
Joanne, what do you think is a misread?
I think that the cuts that the market has priced in are probably a little bit premature. I mean, the Fed is trying to make it really clear that it's very focused on that 2% target and that there's still work to be done to get there and that they're not going to ease off their plan. So I think higher for longer, unless something breaks, is probably what investors should be thinking about. And we even saw folks from the Fed come out, since Powell's press conference trying to reverse some of the decline in interest rates and some of the cuts that got priced in. I think that was a bit of a mistake on the part of investors.
Well, let's go back to a question that Torsten Slock of Apollo is asking this morning. If you're bullish on stocks, if you're bullish on credit, lower rated credit specifically, you've got to ask yourself where you think the labour market's going to be in 3 months. John, this was a question that I asked the likes of Julian Emanuel this morning, also Matt Miskin as well. At the moment, people are pointing to the labour market as a reason for the Fed not to be hawkish. When do you start to point to the labour market as a reason to be bearish?
Yeah, so right now we're still in a situation where the labor market's pretty tight. It's gotten a little bit better, but it's actually hard to parse the data. And on the one hand, yeah, fewer hires suggests perhaps that the labor market is loosening, and so there'll be less wage pressure, and so the Fed has less work to do. On the other hand, it could simply be that firms are running out of workers to hire, and that's why the numbers are dropping a little bit. So ultimately, you have to look through the actual numbers of people being hired to the wages and employment cost index. And we're still seeing pretty significant pressure there, pressure that's not quite consistent with 2% inflation. So you asked the question, when do you become bearish? Well, I think right now it's premature to assume that we're going to see cuts anytime soon, because the pressure still seems to be coming from that labor market. And so we have to be cautious. That doesn't mean you don't want to stay well diversified and exposed to equities, because over the long term, those are still going to serve your portfolio well. You just want to be a little bit careful about where you have your exposure at this point in time.
Well, talk to me about where you want to do that. Where do you find protection within equities?
Yeah, when we talk to clients, they get a little bit nervous about what's happened over the last year, the market being driven by 7 companies, right, for much of the year, and income-oriented, dividend-paying stocks being down, the average stock being down. And what they eventually recognize is that when they own companies that provide protection against recession, when they own companies that provide dividends, that can sustain them over the long term. So protection in this kind of a market, you own something like a TJ Maxx. You own something like a McDonald's. Even with the weight loss drugs, we think McDonald's is going to hold up just fine. And you can also own some higher income payers, whether it's an AbbVie or a Cisco or an IBM, that still give you some appreciation potential because they're long-term growers, but also give you much higher than average dividend yields to help carry you through the stock price volatility.
Joanne, why don't you think the likes of Novo Nordisk, Eli Lilly, aren't the McDonald's killer that other people think it is?
Well, because you have to ask who's going to get access to these drugs first. And folks lower down the income scale may not get as much access as wealthier folks with more generous healthcare plans. So these are expensive drugs. It's not clear who's going to get access to them and when. And so that's one reason. Another reason is, if you kind of have a bigger budget in terms of calories, because you're getting this benefit from these drugs, it's not clear that's going to stop you from going to McDonald's. Also, it's a very cheap source of protein. It's a very cheap source of food. And when you're on a tight budget and, you're going to try to feed your kids, you're going to keep them happy, unfortunately, that means a lot of people end up going to McDonald's. And I don't think that's going to change very much, given how these drugs are priced for now.
About 13 minutes into the session here, just about holding on to these gains on the S&P 500. Joanne, let's finish on tech. Tech this year, the likes of Meta up by 166% year to date. Nvidia up by 224%. Meta has gone through all this cost cutting expenses and still getting all of this growth on the top line as well, and on the bottom line for that matter too. Joanne, can you just talk to me about what you like in tech right now and what you don't like? Because one thing that jumped out for me, particularly after ARM earnings just yesterday, forecasting some pretty soft revenue, at least the midpoint came in below estimates. You think this cyclical smartphone decline is nearing an end. Joanne, why do you think that's the case?
Well, we're seeing inventories clear, for one thing. We went through, it's been a long time since folks bought their smartphones at the depths of the pandemic. They upgraded their technology, and we've seen now that drop off a cliff, right? But it happened a long time ago, like probably 4 to 6 quarters ago. And we're starting to see the inventories of the parts that go into smartphones really come back down to normal levels. So that tells us that's been absorbed. We're also seeing, lots of signals out of Asia where these phones are built that they're starting to pick up a little bit. So the ground level data is telling us this is starting to recover. And the same thing is happening with PCs. But beyond that in tech, right, what you want to think about is what's going to happen over the next 5 years. And so the companies that are enabling, right, this adoption of AI and all sorts of applications, companies like Microsoft, that's one of our favorites. Amazon, we think, is going to start being a user, and they just talked about a new large language model that they're going to deploy. So we think there's just a lot of applications that have yet even to be invented that we think these big cloud providers like Amazon Web Services, Microsoft, Google are all going to enable. And we think that's a good thing, a good area to own for the longer term. And they're also able to control their costs and deliver incredible free cash flow, which they can use for a little bit of a dividend or to buy back shares or to reinvest in growth. So very solid business models in a growing area of the global economy.
Joanne, we've got to leave it there. Great to get an update from you, as always. Joanne Finney there of Advisors Capital. This is going to be so tedious today. We're about 15 minutes into the session. We've got really, really muted gains on the S&P 500. And as you know, if we close positive today, it's the longest winning streak on the S&P 500, day 9, going back to November 5th, 2004. Just about positive at the moment. Coming up, Secretary Yellen preparing for 2 days of talks with China.
foreign companies are incredibly important for the Chinese economy. And right now, they're trying to reverse the cycle of exodus.
Team coverage up next.
Foreign companies are incredibly important for the Chinese economy. And right now, they're trying to reverse the cycle of exodus, that everyone essentially is blowing out of China because there's no confidence that that is a profit center for companies going forward. And China's trying to say, hey, we have a friendly environment for you guys. Come on back.
That was Bill Lee of the Milken Institute. Secretary Yellen kicking off 2 days of talks with her Chinese counterpart in San Francisco. This coming ahead of a long-anticipated meeting between President Biden and Xi Jinping next week. The White House facing pressure to hike tariffs on vehicles made in China. A bipartisan group of lawmakers writing it is critical that tariffs on Chinese automobiles not only be maintained, but also increased to stem the expected surge in Chinese imports. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in Washington, D.C. Katie, walk us through the next couple of days.
Well, it begins today when Treasury Secretary Janet Yellen is going to be meeting with her counterpart, He Lifeng. And of course, the issue of economic competition is really going to be front and center, which speaks to the idea of the tariffs still in place on Chinese goods that were put in under the Trump administration. And the Biden administration to this point has not abandoned. No sign that they will. And of course, now a bipartisan group of lawmakers, notably the chair and ranking member of the House Committee on the Select Competition with the Chinese Communist Party, are even pushing for intensified tariffs. So that may set a bit of a difficult scene as Secretary Yellen prepares for this meeting. Also setting a difficult scene is the fact that China, by Beijing, by way of Chinese state media, was airing out economic grievances overnight related to the U.S., talking about the lack of a level playing field for Chinese firms, also noting that U.S. efforts to cut China out of supply chains, some of the export controls have been put into place. Beijing saying hurts U.S. firms. Of course, Secretary Yellen, on the other hand, in these meetings is likely to say the reverse, that there is an unlevel playing field for U.S. firms in China. And she is likely to reiterate what we have often heard from her and other administration officials, that the U.S. is looking for competition with China in a healthy way. It is not trying to hold back the Chinese economy, but also they want to diversify and de-risk, not necessarily decouple, but diversify and protect U.S. national security interests in doing so. This, John, of course, is part of an ongoing effort after in July, Secretary Yellen made a trip to Beijing for these similar kind of conversations. Other administration officials trying to normalize relations as well. All of it setting the stage for the big event next week.
Nobody say decouple. No one's allowed to say decouple. You got that? That seems to be the rule right now.
De-risk.
De-risk. De-risk. Diversify. Diversify. OK. AMH, walk me through this. How does this set the stage for next week?
Well, Xi Jinping will be going to APEC. This is what all the tea leaves are telling us, even though the Chinese have yet to fully put that out there in black and white, Jonathan. But he's not only going to be meeting with Commander-in-Chief Joe Biden, but he'll be meeting with executives as well, the CEOs of America's biggest companies. We don't know the exact list, but there's going to be a dinner. There's a CEO summit alongside the APEC meeting, and you can see the likes of Satya Nadella of Microsoft there or Darren Woods of Exxon. So this is really important for Xi Jinping as much as it is for Joe Biden. Remember, China is dealing with a very fragile economic recovery. They want to woo investors, and they also want to make sure that they are sending a message that we are still open for business and really try to tamp down some of these concerns when it comes to geopolitics. And this administration, Jonathan, does also need this meeting to go well. Can you imagine going to an election year when you have a conflict still in Europe with Russia's invasion of Ukraine, a conflict in the Middle East with Israel and the ongoing war with Hamas right now, backed by Iran, and then potentially a conflict in the Asia Pacific? They want to make sure that they tone this down and put a lid on this.
It's true. Looking forward to the coverage from both of you over the next week or so. Anne-Marie, thank you, alongside Katie Lyons down in Washington. Let's get you some sector price action. Equity still just about positive with the sector price action. Here's Abby.
Well, it is a very small gain, but to your point, the best, longest, I should say, winning streak going back to 2004. Helping out today, communication services up 0.5%, really being helped out by Disney. Industrials up 0.5%, energy, materials, tech all higher. To the downside, that we have some of those defensive sectors, healthcare, excuse me, and consumer staples in particular, although discretionary is down there. As for this rally, John, the best sector over the last 9 days, well, not surprising probably to anybody, it is technology, up nearly 10%. But we've had the S&P 500, again, the longest winning streak for such a long time. For the tech sector, not so much. It's a much more recent winning streak, but nonetheless, very impressive.
What a rally. What a run on the S&P 500. Abby, thank you. On the Nasdaq too. On the S&P 500, it could well be day 9 on the S&P. We've talked about this 2004 stat again and again. It's worth considering. Over the last 9 days, we're talking about a gain of something like 6.5%. It's quite a run. Up next on the program, your trading diary. Potentially 9 days of gains on the S&P. Let's get to the trading diary. Your day ahead looks like this. The Treasury selling $24 billion of 30-year bonds. Secretary Yellen meeting with her Chinese counterpart a little bit later this afternoon. Biden speaking later in the hour alongside UAW President Sean Fain. Chair Powell set to speak this afternoon as well at 2 p.m. Eastern Time in Washington. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.